All right, let me do a few of these formulas using some interest rates. We're going to talk about how the excuse me, how the Fed works with changing interest rates. It's in this morning's paper that the Fed is not going to change interest rates now, but it's going to wait till December. But here, when you borrow money, of course, you got to do it at some kind of interest rate. So in this first example up here, we're borrowing money for you, buying a car, a credit card, business borrowing money to expand. It's always the same, basically, formula. So if I'm doing monthly payments, like say your credit card bill, your car payment, your house payment, you buy something at an interest rate, so here 5%, you're borrowing $600,000, you're going to pay it back over 20 years. So what's my monthly payments going to be? And again, this can vary depending, especially if you take out a loan that has a variable interest rate. So again, sometimes interest rates will go up, and then the interest rate you borrowed money on in the past will go up too if it's a variable rate. So my monthly payments are going to be this PMT function. The formula isn't that, the actual math isn't that hard, but we might as well use the PMT function that Excel has, my payment function. And again, first thing it has to know, of course, is the interest rate, which is very important. And because we're doing monthly payments, all of Excel's formulas are set for yearly payments financially. So if we're doing monthly payments, we got to divide the interest rate by 12, comma. And then we're going to then use the, what does it say, NPER. And again, with Excel, NPER is always time, right? Number of periods it stands for. So years to repay is our time. And again, this is monthly though, so how many months in 20 years? Of course, you have to multiply, if I can find that key on my keyboard here with my Mac, because I never use my Mac, times 12, comma, and then the last thing is the PV, right, the present value for the loan. What is the bank is going to presently give me the $600,000. I'm going to pay it off in the future. That's why it's the present value, it's called. So there's my formula. B2 divided by 12, B4 times 12, B3 is the amount for the loan. So if I enter, boom, there's my $4,000 a month it's going to cost me. If I buy this house, buy this apartment for $600,000. And here's the thing with interest rates, especially for businesses and individuals, they have a variable rate. If interest rates start to take off, again, the Fed decides to really, there's an inflation problem, and the Fed decides to tackle inflation, and they raise interest rates, which they can easily do. So if they make it up to 6% a year, right? Notice there my monthly payment jumps up to $4,299. And again, in the late 1970s, 1980s, interest rates were going for a lot of loans. Were going for like 19%. And if the interest rates jump like that, with huge inflation, is one of the problems was. Look at it's doubled or almost tripled my original monthly payment to $9,000. So interest rates will make, again, things more expensive for people to pay off their monthly bills. Businesses pay off their monthly bills, especially if individuals' wages aren't keeping up with inflation. So just be careful when you take a loan out in the future. Again, a lot of times you'll get a cheaper loan, cheaper basically monthly payment if you get a variable rate for your loan. But if you get a fixed rate loan, again, it's a little more expensive, your monthly payments, but you know exactly what you're going to be paying. But you never know, interest rates might go down in the future. So the future's so hard to figure out. So as the next one goes, the future value of money. If you're saving money, if you're putting money in the bank. So the first one, basic example, is people borrowing money. Here's the other example of people saving money. Where banks, again, I put money into the financial sector, and then that loans it out to other people that are buying things, they're going to be paying it back. So if I save money for my retirement, these financial institutions will loan the money out to other people. So they're going to give me a rate of my return. I get some money, compounded interest. So let's see, I'm putting away $5,000 a year here. So here I'm doing yearly values to make our formulas easier. 40 years and a 5% interest rate. So how much money am I going to have in the future, right? If you just type 5,000 times 40, because I'm putting in $5,000 a year, right? Times this 40, I'll get what, $200,000, right? Again, the years to contribute is a negative number because you're putting money in. I want to get a positive money out at the end. That's why it said minus $5,000 in the beginning. So, but to really see how much money you're going to get, it depends on the interest rate, on the rate of return on your money, right? And again, there's different retirement accounts, and they will basically approximate the interest rates will be over the years, but no one knows for sure, again, because it is the future. So here I'm going to use my FV function, future value, open paren. So as soon as I hit the open paren, it shows me the three parts I need for this formula, right? The rates, number of periods again, and my payment, the money I'm putting into my plan. So the rate, again, I invest in this 401k. It says it's going to pay me generally 5% rate of return over the years, comma, number of periods, NPER, again it's 40 years till I retire, comma, and then the payment, right? So B11, B10, B9, close my paren, enter, and I'm going to have $600,000, right, in the bank when I retire. But again, this can vary with the interest rates, right? If interest rates go up a lot, or if I take a more risky investment. So again, if I invest in real estate, is generally sometimes very risky investments. You can make money, you can lose money. So sometimes you can make, like say again, 8% interest over years, and again, we'll see this will double the amount of money I'll have, 1.2 million. If you, again, put money into an investment bank, and if you have a lot of money, they'll give you a high rate of return. Again, some people will say if you're not making 11% on your money, you are a chump. I've heard this phrase at parties. So at 11% interest, I'll have almost $3 million. Again, compared with that original 5%, which was just $600,000. So here I'm going to make back a realistic, like say 9%. And it's not enough money for me, so this is what I tell my wife all the time, right? You got to work longer. So instead of 40 years, I'll work 45 years. And you can see, boom, it's amazing the amount of money will change if you just work a little bit longer. Or if you put a little more money away, I put an extra $1,000. I put in 6,000 because I got to do a minus, of course, because I'm doing negative numbers. Right? Boom. So you can just play around with different values here to do some what-if scenarios with the future value. And again, the interest rate is very important here. So another one, I'm going down below here. If in a business you want to invest money, and this is how you do a business plan, right? You're trying to get money from someone. I want to borrow $100,000. So that's what's in A18, right? I want to borrow $100,000, and then in a business plan, you got to show basically your net profits for out in the future. So in year one, I'm going to make $9,000. Year two, I'm going to make $9,500. Yada yada yada. Out to year 5, where maybe I could sell the business and get this $65,000. So you've got to plan out in the future what's going to be the profits for this business over time. Again, investors want to see this, and hopefully you do some research to back up your numbers here. Again, this is when all your other classes for talking about projections into the future for revenues. Hopefully they talk about it. So here, again, I got all these numbers. I'm investing $100,000, borrowing $100,000, and this is basically the money I'm going to be earning. My total revenue minus my total cost. We'll figure out my profits over the years. So is this a good investment or not? So if I just go out here, like say, and do a sum, I sum up these numbers just from year 1 out to year 5, right? $119,000, right? Look I'm making $19,000 over my original $100,000, right? Business people will laugh at you if you try to borrow money doing it this way, because these future dollars, again, year 1, year 2, year 1, if this is next year, it's 2018, right? And then 2019, going out into the future. you have to basically discount those future dollars with an interest rate. Because I could take the $100,000, right? If I'm an investor, I could take that $100,000 and invest it again in some real estate deal, and I could be making, like, say, 12% a year. Right? So why should I invest in your company if I could invest in it someplace better with a higher interest rate or a better interest rate? You got to show me what your future dollars look like in today's dollars, right? Discounted at an interest rate. So here I'm looking at 15%, because again, some businesses, they have a set number you have to hit, right? I'm not going to start this new line of clothing unless I get 15% basically rate of return on my money, right? I get this, hit this projection. So you look at the future dollars, you can figure out the profits, again, these $9,000 to $65,000, and I have to discount them in today's dollars with an interest rate to see if it beats this $100,000, right? Because again, $9,000 a year from now is not worth $9,000 in today's interest, because I could put money in the bank and make an interest rate off of that, and it would get that extra money a year from now. So the present value of these future dollars, that's what I'm going to do. So this is called, I'm going down here, what, C21, I'm putting this formula in, net present value, NPV, open paren. And again, the first thing I want to know is the rate, right? So again, this is that 15%. I'm dealing with years, again, so I don't have to worry about dividing by 12. And then comma, I've done that one. And then the next one is just the values, right? So I'm starting from the 9,000. I'm not looking at that $100,000. I'm going to basically, I want to see the future value of these dollar amounts, right? Again, if I just sum them up, it's 119,000. But I have to discount them at a interest rate, which here the company has told me is 15%. And again, most companies do have this benchmark you have to beat for an investment. So I'm going to close my paren, enter, and there, you can see these future dollars, this $119,000 of future money, is really worth, in the present value, $69,000. So if this is an individual company and their target is 15% interest rate you have to beat, this is not a good investment, right? Because in this $69,000 does not cover the $100,000 that's was the original investment. Excuse me. But again, depending on interest rates, companies will change this target, and investors will look at different numbers. So if interest rates go down, like say I'm going to make a big change here, it's like 7%. Notice the future dollars is down to 91,000. I'm getting closer to the $100,000 investment, right? If I make it around 3%, boom, here it's making, this at 3% interest, this 106,000 in future dollars now, because again, the interest rate is making those future dollars worth more, basically. I'm beating this $100,000. So if my rate of return was set at 3%, this is what the investors are looking for. This is a good investment. So now skip the internal rate of return. I'll come back to that later maybe. But one more thing here, this money multiplier, this is besides interest rates. This is dealing with how the Federal Reserve can create money. As I said before, the Fed puts in money into the system and it takes money out of the system. So, and when the Fed puts money into the system, it creates a lot more money than the initial amount. Because, and I'll talk about this more on Monday, but this is a formula I would like to see you have for the final, so you might as well have this as an Excel spreadsheet. But say if the Fed puts in $500,000 into the economy, and the reserve ratio is 11%, and what the reserve ratio is banks have to keep a certain amount of cash on hand, right, in reserve, in case people want to take their money out of the bank. Because banks' role in this society, right, is they take in deposits and then they basically create loans. And when they create loans, right, I buy a house, I borrow from the bank, I take out a loan, I pay the house builder when the house builder gets my money, they put that money into the bank, right? Again, if you borrow, again, 500,000, you borrow for that amount for the house, which is up above, the bank will, again, the home builder will take that money and put it in the bank. So again, large transactions, money goes back into banks because that's how you make money, right? With interest rates. So here, what happens is then the bank that gets the money from the house, right? They will automatically loan that money out to somebody else because banks make money by loaning money out. So money basically revolves around in the system, right? As soon as, again, a big purchase is made, it goes into another bank. That bank will loan the money out. Again, that money gets loaned out to somebody else, like say buying a big boat. The person that sells the boat gets the money, they put it in a bank. So money keeps multiplying. This is why it's called the multiplier effect. So if banks have to keep 11% of their, again, cash in reserves, right? Again, they can't loan out everything they get. They have to keep 11%. The Fed makes them do this. How much money is created through this original 500,000 that's deposited by the Fed, put in by the Fed into a bank? So it's kind of an easy formula. It's just the original amount, right, times, and again, an open paren here because I don't have a calculator, 1 divided by the reserve ratio, right? And I will do this one again on Monday in class. But this will show you how much the Fed actually creates money. They deposit $500,000 into the banking system to raise the money supply. If there's a recession, again, they raise the money in the economy, and it really creates $4.5 million. Right? And again, this is the money that is just into the system that keeps being loaned out to other people. People buy something, they put it in the bank. The bank loans it out, minus, again, the 11% that the reserve ratio is, and somebody else buys something, whoever, again, gets that money from what they buy goes into another bank. So again, this is how money is really created. So the Fed, if they put in, like, say, $700,000, this is why the Fed has to figure out, with a lot of statistics, how much money to inject in the system. It will create, $6 million. So the Fed